Hello traders. RSI is a tool for measuring the speed of price fluctuations. The scale ranges from 0 to 100, corresponding to strength from low to high. We are interested in 3 important levels. 1. When RSI is above 70, the market may be overbought. 2. When RSI is below 30, the market may be oversold. 50 means the market is sideways. Above 50, the price is in an uptrend. Below 50, the price is in a downtrend. An RSI around 70 means the current price is too high and not suitable for opening a buy order. Conversely, below 30, the price has fallen quite low and is not suitable for opening a sell order in this area. But beginners often make a big mistake. Overbuying doesn't always mean selling. Overselling doesn't always mean buying. Always pay attention to the areas above and below 50. I will tell you how to use RSI. Consider the trend. 1. In an uptrend, RSI is usually between 40 and 80. See 40 as the current oversold area. This means that price corrections in RSI near 40, which may be larger or smaller, are oversold areas, potential buying opportunities. 2. In a downtrend, RSI is usually between 20 and 60. See 60 as the current overbought area. This means that price corrections in RSI near 60, which may be larger or smaller, are overbought areas, potential selling opportunities. To identify overbought or oversold areas, we rely on historical RSI data. Here is a real-time example. This is the 1-hour chart of SPY on Wednesday, March 4th, 2026, the time this video was made. SPY is in a strong downtrend. We can easily see that the lower low and lower high. The RSI also moved in the area below 50, reaching a peak of 62. After touching strong resistance, the current SPY price returned to the peak of the previous downtrend. The RSI also returned to its highest peak of 62 to 63 and ended the day trading. With the strong previous increase, many people may have FOMO'd, thinking that SPY would continue to rise. But the result is what you see the next day, which is also the time this video was made. The price dropped sharply if a sell order was opened at the previous closing time. Next, let's combine RSI with support and resistance levels. If the price touches the support level and the RSI is near 30, the market may bounce up. If the price touches resistance and the RSI is near 70, the market may be rejected. One more thing, watch the trading volume. If the RSI gives a signal and the volume increases, the move is stronger, but if the volume is low, the signal may be weak. Remember this simple rule. Trends show direction. Support and resistance show position. RSI helps you identify trading opportunities. Use them together, not individually. RSI divergence happens when price and RSI move differently. This usually means momentum is changing. Bullish divergence happens when price makes a lower low, but RSI makes a higher low. This shows selling pressure is weakening, and price may bounce. Bearish divergence happens when price makes a higher high, but RSI makes a lower high. This shows buying pressure is weakening, and price may drop. Traders often look for divergence near support or resistance. But remember, divergence is a warning, not an instant trade signal.